Remember that 3% raise your boss gave you last year? You probably felt like a winner for exactly 20 minutes, right until you walked into a grocery store. The reality for most Americans aged 30 to 50 is that we are running on a treadmill that is moving faster than we can sprint. You see the numbers on your paycheck go up, but the quality of your life stays the same. Or worse, it starts to feel a little more cramped every single month. That's because standard annual raises are currently being swallowed whole by a 10 to 15% increase in the actual cost of living in the United States. If you're relying solely on your salary to build wealth, you're not just standing still, you're actually falling behind. And that's a dangerous place to be as you head toward retirement. Building passive wealth isn't some get-rich-quick scheme or a luxury for the ultra-wealthy anymore. It has become an absolute necessity for survival in the modern economy. We've been taught to work hard for our money, but we weren't taught how to make that money work hard enough to outrun the invisible tax of inflation. Every time the price of a gallon of milk or a gallon of gas ticks up, your purchasing power is being eroded, and no amount of hustle can fix a broken math problem. This is why the old school mentality of just saving doesn't work anymore. You can't save your way out of a currency that loses value every single day. So how do the people who actually get ahead do it? It isn't because they're smarter than you or because they have some inside connection on Wall Street. It's because they've stopped acting like hunters and started acting like farmers. Most amateur investors are hunters. They wake up every morning looking for the next big kill, the next AI unicorn, or the next meme stock that's going to go to the moon. The hunter mindset is exhausting because it requires you to be right every single day, and if you miss your shot, you go hungry. When you see a headline about a tech company jumping 20% in a week, the hunter in you wants to grab a spear and jump in, usually right before the price crashes. But the farmer doesn't care about today's weather or which animal is running through the woods. The farmer cares about the soil and the seeds. Instead of hunting for one lucky break, the farmer plants seeds in broad market index funds like the S&P 500 and lets time do the heavy lifting. The S&P 500 isn't just a number on a screen. It's a collection of the 500 largest, most profitable companies in the United States. When you buy an S&P 500 ETF, you are essentially hiring the world's best CEOs to work for you while you sleep. Think about it this way. Tim Cook is waking up every morning trying to figure out how to make Apple more profitable. If you own the index, he's working for you. You don't need to be an expert in semiconductor technology or global logistics when you own the entire system. The farmer's secret isn't intensity, it's consistency. They know that a seed planted today won't be a tree tomorrow, but it will be a forest in 20 years. But even the best farmers know they need a fence. You wouldn't plant $1 million crop and leave it completely exposed to the elements, would you? In the world of investing, your fence is your allocation to U.S. Treasury bonds. I know, bonds aren't sexy. Nobody goes to a cocktail party to brag about their 2-year Treasury yields. But they are the only thing that stand between you and a total panic attack during a market crash. Look at what happened in March 2020. The world felt like it was ending, and the market was a sea of red. If you were 100% in stocks, your net worth was evaporating in real time, and that's when most people make the mistake of selling at the bottom. But if you had 10% of your portfolio in treasuries, you had a fence. You had liquidity and stability when everything else was on fire. A simple system like the one Warren Buffett recommends for his own family is 90% in a low-cost S&P 500 fund and 10% in short-term government bonds. This isn't about hitting a home run. It's about making sure you never strike out so hard that you have to leave the game. When you have that bond fence, you don't have to worry about the short-term news cycles or whether the Fed is raising rates by a quarter point this month. The market is volatile by nature, but over the long run, it has a gravity that pulls it upward as companies innovate and grow. If you can just stay in the game, the math starts to do things that feel like magic. Have you heard of the Rule of 70? It's a simple way to figure out how long it takes for your money to double. If you earn a 10% return, which is the historical average of the market, you divide 70 by 10. That means your wealth doubles every 7 years. Just think about that for a second. If you have $100,000 today and you just leave it alone in a broad market system, it becomes $200,000 in 7 years. In 14 years, it's 400,000. In 21 years, it's 800,000. And in 28 years, that original amount has grown to over $1.6 million. The best part? You didn't have to beat anyone. You didn't have to spend your weekends reading quarterly earnings reports or listening to talking heads on CNBC. You just had to trust the system and stay out of your own way. Wealth in America isn't built by being the smartest person in the room. It's built by being the most disciplined person in the room. Success is about systems over IQ. You don't need a genius-level intellect to understand that American corporations are the greatest wealth creation machines in history. You just need to own them. All of them, all at once. The hunter tries to guess which company will win next year. The farmer just owns the whole field and waits for the harvest. A lot of people in their 40s feel like it's too late, but the best time to plant a tree was 20 years ago. The second best time is right now. You still have multiple doubling cycles left in your career if you start today and stop chasing the noise. We live in a world that is designed to keep you distracted and keep you spending. Your phone is buzzing with alerts about the next big thing or a market crash because fear and greed sell subscriptions and drive clicks. But the market doesn't care about your feelings, and it certainly doesn't care about the news cycle. It only cares about productivity and profit. As long as people keep buying iPhones, drinking Starbucks, and using Amazon Prime, the system will keep churning. If you want to stop feeling like you're losing ground to inflation, you have to stop being a consumer of the economy and start being an owner of it. The difference between struggling and thriving in the next 20 years won't be your salary, it will be your equity. Are you going to keep chasing the deer through the woods, hoping for a lucky shot while the ground moves beneath your feet? Or are you going to build a fence, plant your seeds, and let the most powerful companies in the world build your retirement for you? The math is on your side, the history is on your side, and the system is already built. All you have to do is step inside. The real question isn't whether the market will go up or down next week. The real question is, are you going to be an owner when it inevitably goes up over the next decade?